All right, so today we're diving deep into Sapphire Foods India Limited's Q2 FY25 performance. And wow, you have really given me a lot to work with here. We've got a press release, we've got official letters to stock exchanges, we have the company's unaudited financial statements, both consolidated and standalone, and we even have a whole earnings presentation. And all of this for a company that runs those big names, KFC, Pizza Hut, and Taco Bell across India, Sri Lanka, and the Maldives. So our mission today, I guess, is to go beyond just kind of the headlines and figure out how Sapphire Foods is really doing.
Yeah, I mean, I think, that's what this is all about, right? It's about understanding the story behind the numbers, especially in a competitive market like QSR. What are the challenges and opportunities that are unique to Sapphire Foods? What does this quarter reveal about their strategy? That's what we're really after.
Yeah, and just looking at this press release right off the bat, they're boasting, 8% revenue growth. They're reaching 6,940 million. EBITDA sits at 1,152 million with a 16.6% margin, and profit before tax before exceptional items is 53 million. Sounds pretty promising, right?
Yeah, on the surface, those numbers look great, but as always, we can't just take things at face value. And one key phrase that really jumps out at me from all these materials is muted demand conditions. This suggests that, the market might be a bit tougher than these initial figures suggest. So I think we really need to dig deeper into industry benchmarks and also look at Sapphire Foods' own history to see if these results are truly impressive or if they're just meeting the bare minimum.
Okay, so context is key. Got it. So now let's break it down by brand. KFC India, they saw 9% growth in restaurant sales overall, but same-store sales actually dipped 8%. Now, the company attributes this to Q2 coinciding with vegetarian festivals in India.
Yeah, that's definitely an important detail to consider. But I think the savvy investor is going to want to know, how deep is this dip compared to previous years during the same period? Is this 8% drop within normal fluctuations, or is it a sign that KFC India is losing ground? Those are the things that we need to analyze to find out for sure.
For Pizza Hut India, sales grew 3%, which I mean is not nothing, but it's not a ton. With same-store sales also down 3%, they doubled their marketing investments this quarter, and they rolled out some new products. But are those moves really paying off?
That's a great question, and it's something that we really need to take a look at. Increased marketing should ideally translate to increased sales, but that's not always the case. I think we really need to dig in and assess the effectiveness of their campaigns. Are these new products resonating with consumers? Are they actually gaining market share? Or are they basically just throwing money at a problem?
Now, for a bit of good news, Sri Lanka is showing a pretty strong recovery with 19% sales growth. So maybe a sign of things to come.
It's definitely promising, but we need to figure out what's driving that growth. Is it pent-up demand after the pandemic? Improved economic conditions? Really effective marketing campaigns? We need to figure out what's going on there to figure out if this is going to be sustainable.
On the other hand, the Maldives is painting kind of a grim picture with a 57% sales decline, largely due to geopolitical issues. This actually led to a 114 million grog impairment charge.
Yeah, I mean, that's not great. It definitely raises some critical questions about risk management and diversification. Is Sapphire Foods maybe overexposed to these volatile markets? How much of this decline is due to external factors versus things that they could actually control? And I think most importantly, what steps are they taking to try to mitigate these losses?
Well, speaking of expansion, they did add 23 new restaurants this quarter, bringing their total to 909. But is that pace sustainable?
Well, I think, expansion can be a double-edged sword. On one hand, it fuels top-line growth, but on the other hand, it also requires a lot of spending and also operational efficiency. So we need to compare Sapphire Foods' expansion rate to the industry average, see what their competitors are doing, and most importantly, we need to figure out if they can actually maintain profitability and operational excellence with so many new locations coming online.
And let's not forget their big digital push. Both KFC and Pizza Hut are rolling out kiosks and apps. But is that strategy actually working?
Well, I mean, digital transformation is kind of a must-have in the QSR landscape these days, but execution is everything. So we need to figure out how well Sapphire Foods is integrating these initiatives into their operations. Are they driving engagement and loyalty? Are they generating valuable data that can inform their strategies? Those are the questions we need to answer.
Okay, so before we dig into each brand's performance, let's take a step back and look at Sapphire Foods' overall financial health.
Exactly. We need to look at their debt position and their cash flow, especially with these ambitious expansion plans. Are there any red flags in their financial statements? And how do they compare to their industry peers?
And speaking of insights, the investor release and earnings presentation are just full of management commentary, all about their strategic focus and their outlook for the future.
Yeah, and sometimes that commentary can be more revealing than the numbers themselves. What's the tone? Are they optimistic? Are they cautious? What are they choosing to emphasize? Reading between the lines can give us some really valuable clues about their priorities and their concerns.
And of course, we can't forget to look at how the stock market reacted to all of this. Did their share price go up? Did it go down? Did it stay flat?
Yeah, the market reaction is like immediate feedback, but we got to figure out why it moved the way it did. Did the results match what analysts were expecting, or were there any surprises?
Okay, so we definitely have a lot to go over. But before we get into the numbers, there are a couple of things I want to point out.
Okay, I'm intrigued. What did you find?
So first of all, there's a new guy on the board. Mr. Rohit Mutu has been appointed as an additional director, and his background is mainly in investment and private equity.
Interesting. Could this mean that there's going to be a shift in their financial strategy? Maybe more acquisitions or partnerships? We'll have to see how his expertise comes into play.
The other thing I want to mention is that they're planning to restructure their subsidiary in the Maldives, probably a response to those geopolitical challenges we talked about.
Yeah, restructuring can mean a lot of different things. Cost cutting, streamlining, maybe even thinking about pulling out of the market. How they handle this is really going to tell us how committed they are to the Maldives long term.
Okay, so we've laid the groundwork and identified the key areas that we want to investigate. Now let's dive into the numbers and see what kind of story they tell.
Let's do it. The numbers are just waiting to be deciphered. You know, going back to those muted demand conditions you mentioned before, I think it's worth asking, what did that actually mean for the QSR industry?
Yeah, that's a good point. We shouldn't just kind of gloss over that. What are we really talking about here?
Basically, it means people aren't spending as much on fast food. There are a lot of things that could be causing this, like maybe some economic uncertainty, or, inflation is eating into people's budgets, or maybe people are just trying to eat healthier or more affordable food.
So it sounds like this is something that Sapphire Foods is up against, but it's not just them. It's an industry-wide problem.
Exactly. So knowing that, let's look at their consolidated financials. Their total revenue for Q2 FY25 was $7,041.70 million, which is a bit higher than last year. But remember, this includes all of their subsidiaries. If we just focus on their restaurant sales in India, the growth is actually way more significant. It jumped to $5,903 million this quarter, a 7% increase from last year.
Okay, so even with less demand overall, their India operations are still growing. What about their profitability, though? I know the press release highlighted the overall EBITDA margin, but I'm curious to see the specifics.
So looking at their consolidated gross profit margin for Q2 FY25, it's at 69%, which is pretty much what they've been doing in the past. But their India operations actually saw their gross margin go up a little bit, about 10 basis points higher than last quarter and the same quarter last year.
So they're squeezing out a little more profit from each rupee of sales in India. Is that from doing a better job managing costs or maybe some strategic pricing changes?
Probably a little bit of both. We'd have to really dig into their cost breakdown to see if they've gotten better at sourcing ingredients or if they streamline their operations. It's also possible that they've raised prices just a little bit without scaring off customers, which is not easy to do when demand is already kind of low.
That's a good point. Now, what about EBITDA? I remember that the consolidated EBITDA margin was 16.6%, which sounds good, but I think it's actually a little lower than last year.
You're right. It is. It's important to see how these things change over time. A shrinking EBITDA margin could be a sign of trouble, especially with demand being low. It's possible that their increased marketing spending, which they're doing to deal with the market slowdown, is actually cutting into their profits.
Yeah, those doubled marketing investments for Pizza Hut India could definitely be a factor.
To really see how they're doing on the bottom line, let's look at their profit before tax, not including any exceptional items. For Q2 FY25, their consolidated PBT is only $53 million, which is just a 0.8% margin.
Wow, that's a lot lower than last year. It seems like the low demand is really hurting their profitability.
Yeah, this is a classic example of revenue going up, but profits not following. This shows us why it's so important to look at how well a company turns sales into actual profit.
So things are looking a bit mixed in India, but we did see that Sri Lanka is doing really well with big sales growth. Could that be making up for some of the weaknesses in other places?
Maybe. Let's look at the numbers by region. Sri Lanka's restaurant sales went up 19% in INR terms. And their same-store sales also got a boost of 9%. Plus, their restaurant EBITDA margin went up 20 basis points year over year.
So they're not just Growing fast in Sri Lanka, they're also doing it in a way that makes money. What are they doing right?
I think to understand that, we need to go beyond just the numbers. What's the competition like in Sri Lanka? Have they figured out how to appeal to specific tastes or trends in that market? Are their costs lower there? Those are the kinds of things will tell us if this success is going to last.
Good point. We need to know the why behind the numbers, not just the numbers themselves. Now, before we move on, I think we need to talk about that big impairment charge related to the Maldives.
Right, that 114.20 million charge, that's basically because their assets in the Maldives are worth less now,
Yeah.
all due to those geopolitical issues.
Even though it's a non-cash charge and doesn't affect their cash flow right away, it's still a bit of a warning sign. It tells us that their Maldives business is facing some serious problems, and they might need to rethink their whole strategy there.
Absolutely. This shows us how important it is to spread out your risks and really think about what could go wrong, especially when you're operating in places that are a bit unstable.
So we've covered the consolidated results, which give us a big picture view of the whole group. But now let's zoom in on their standalone financials, which will just focus on the parent company's operations in India.
Yeah, comparing these two perspectives is always a good idea. For Q2 FY25, their standalone revenue was 5,907.50 million, which is a pretty big chunk of their total revenue. But their standalone PDT, before exceptional items, tells a different story. They actually had a loss of 150.29 million.
Wait, a loss? But I thought they were growing their revenue in India.
Well, this is why it's important to understand the difference between consolidated and standalone financials. Even though their overall business might be making money, their standalone operations in India are actually struggling. But that's hidden when you include their profitable subsidiaries in the consolidated numbers.
So it's not all good news in India, even though the consolidated results might make it seem that way. We need to really break down these standalone financials to see what's dragging their profitability down at home.
Exactly. Let's dig in and figure out what's going on. Okay, so let's get into those standalone financials, specifically for their operations in India. Their standalone gross margin for Q2 FY25 was 68.3%.
So that's actually a little bit higher than their consolidated gross margin, which includes Sri Lanka and the Maldives. Does that mean they're better at controlling costs in India?
It could, yeah. Maybe they're sourcing ingredients better in India or their operations are just more efficient there. But even with a decent gross margin, they're still losing money on a standalone basis.
Right. So what's eating into their profits in India? Is it just that muted demand we talked about before?
Well, that's definitely part of it. But when you look at their standalone expenses, it's clear that there's more to it. Their employee expenses have gone up compared to last year, and their other expenses like rent, utilities, and marketing have also increased.
So basically, their operating costs are going up, and that's contributing to their standalone loss, even though they seem to be doing a good job managing their cost of goods sold.
Exactly. They're kind of stuck between a rock and a hard place. Costs are going up on one side and on the other side. They need to keep their prices competitive because demand is already weak.
It sounds like they need to figure out how to cut costs without sacrificing quality or making their prices too high for customers.
Right. And remember, they're also trying to open a lot of new restaurants, which can be great for growing revenue, but it can also hurt your margins if you're not careful.
So they need to find a balance between expansion and making sure their operations are efficient and their costs are under control.
Absolutely. Now, before we wrap up, I want to go back to those two things we talked about earlier. The new board member, Mr. Rohit Muthu, and the restructuring in the Maldives.
Right, so Mr. Mutu comes from an investment and private equity background. Could that mean Sapphire Foods is going to start focusing more on acquisitions? Or maybe he'll push them to be more disciplined with their spending, especially now that they're facing these challenges?
It's definitely possible. His expertise could be really valuable as they figure out if they want to buy other companies or manage their debt or just find ways to improve their operations.
And as for the restructuring in the Maldives, I think that makes sense given how much their sales have dropped there, plus that big impairment charge. But what exactly does restructuring mean in this case?
It's hard to say for sure right now, but the way they go about it will tell us a lot about how committed they are to the Maldives. Are they just trying to ride out this rough patch? Or are they thinking about leaving that market altogether?
Okay, so we've covered a lot of ground here. We looked at Sapphire Foods' financial performance, we talked about their strategy, and we even considered the bigger picture of what's happening in the market. So what are your main takeaways? What should our listeners be watching out for as Sapphire Foods moves forward?
Well, I think the first thing to keep an eye on is their expansion strategy. Growth is good, but it has to be sustainable. They need to show that they can keep their operations running smoothly and manage their costs as they open all these new restaurants.
Makes sense. What else?
I think they also need to figure out how to keep up with the changing tastes of Indian consumers. Like we said, demand is down and people's preferences are changing. So they need to innovate, not just with their food, but also with their marketing and their digital presence, and basically just how they interact with customers overall.
Right. So keep an eye on the menu, A&D, everything else.
Yep. And then, of course, we need to watch their financial health closely, especially their debt and their cash flow. They're going to need a lot of money to keep growing like this. So they need to find a balance between expansion and making sure their finances are solid.
And lastly, I guess we should pay attention to any big moves they make, like bringing Mr. Muthu onto the board or restructuring their business in the Maldives.
Yeah, those kinds of actions can give us clues about where they're headed in the future.
Well, I think this has been a really insightful look at Sapphire Foods. Thanks to you, our listeners now have a much better understanding of their performance, their strategy, and the challenges they face.
It's been my pleasure. Now it's up to our listeners to take all this information and form their own opinions. What do you think Sapphire Foods needs to do to stay ahead of the competition and the fast-changing world of QSR in India? Where should they focus their energy? More expansion, maybe revitalizing their brands, or something completely different?
Those are some great questions to think about. And remember, this is your deep dive too. Thanks for joining us, and we'll see you next time.